I have missed one of the biggest bull run of my life. Companies like AMD, Micron, SanDisk have gone absolutely parabolic, but as a contrarian value investor, I cannot chase stocks trading at 100 times earnings, and this AI infrastructure hypes gives me dot-com bubble feelings. So instead of buying at the top, I'm looking at the bottom. Today I'm going to show you 7 beaten down stocks that feels cheap and I'm watching closely. But first, let's quick look at these AI companies as comparison, and let's be honest, there is no way around it, I regret not buying them. AMD. The price exploded. It's not common to see a company this size quintuple in value in just 1 year. Looking at this price and sales line, rarely AMD trade at such high valuation. And I agree with forecaster, we are currently in overbought territory. The current market sentiment is FOMO. Does this mean AMD will crash soon? Not necessary, but it is trading at a normalized P over 100 with very fast growth. If we assume 33% CAGR, we have a 5 years forward P around 32. On my value chart, that is on the expensive side. I missed out on AMD and I'm not buying now at such rich valuation. Micron is another crazy story. This company just 10x in a little bit over 1 year and is now close to 1 trillion valuation. The numbers for Micron are completely insane. 67% margin last quarter, and this is one of the highest margin company I've ever seen. But memory is extremely cyclical. Up, down, up, down, up. It would be a mistake to consider 67% as the new normal. However, they will profit greatly as soon as this memory shortage lasts. It is a little bit cheaper than AMD, but still not a bargain. Another crazy memory company is SanDisk, and this chart is really insane. From $30 up to $1,500 in 1 year, a 50 bagger. If only I would have bought it 1 year ago and held it until now, I could officially retired. Of course, I did not. Valuation-wise, it's very hard to forecast margins and growth for a company like SanDisk, but probably it is a bit more expensive than Micron. It is a 218 billion market cap with a revenue of 13 billion. Very high multiples. To sum it up, as a contrarian investor, I'm not participating in this AI gold rush. With my preference, I'm not good holding stocks trading at all-time high. I panic, I get feeling and fears of AI bubble, so it's better I stay out. Congratulations if you're holding these names, well done. I envy you. I hope for you that these AI stocks will keep going up, but it's just not my investment style. Instead, what do I like in today's market? All the companies in my portfolio, of course, you can watch them in this video right here. I can spoiler you the end. Duolingo. I'm sorry, but I have to mention Duolingo a couple of times every video until the share price doubles from my entry point. Today I want to talk to you about 7 companies that are not in my portfolio, but that I'm closely observing. The rule here is simple: as long as I'm not buying, they are going to double in the next 6 months. If you're watching this video 6 months from now, let me know if I was right. First, Celsius. This was my first public trade on this channel, so I keep following the company. Fundamentally, I like how they're growing, and I think they might do well in Europe. I do not like the debt connected to Alani Nu and Rockstar acquisitions. It makes it riskier than 1 year ago. Looking at the chart, I'm hoping for a double bottom here, around 21, 22, but at $30 it's already a discount. It's not crazy cheap, but we are close to my green area. Keep an eye on Celsius. In many ways, a very similar story. Stock number 2, e.l.f. Beauty. Great revenue growth, but more depth than when I bought last year. If we look at the chart, e.l.f. just did a double bottom. Will this $50 support hold? I don't know, but if it keeps dropping at the bottom of this channel, I will buy big. Looking at forecaster, we can see a disconnection between the revenue keep going up and the stock price keep trending down. Valuation-wise, e.l.f. is quite cheap already. The last cheap retail company worth mentioning is Lululemon. I understand fashion as a weak moat. After my last year experience with Abercrombie, I'm very skeptical and careful, and for this reason I'm waiting the next earning report of Lululemon. However, I would not be surprised if we have seen the bottom for Lululemon already last week, and now we are about to see a big bounce. Lululemon earnings are high and the share price is low. Even my valuation models say Lululemon is just too cheap. Moving from retail to software, there are a lot of opportunities here. The only problem is that AI might really disrupt some software company. So the main question we have to ask ourselves is, will AI disrupt this business? Will AI disrupt Duolingo? Impossible. Absolutely no. No, come on, no. Probably not. Let's hope not. So, will AI disrupt CRMs like Salesforce, HubSpot, Monday.com? Maybe. However, I feel that the risk is already more than priced in. If we look at HubSpot, for example, we got an 80% price drop in a little bit more than 1 year. Revenue is up, cash flow is up, and they have more cash than debt. We have the opportunity to buy this company at 2019 levels, while the revenue 5x or more. Again, will AI disrupt CRMs? If you think not, keep an eye on HubSpot. Another software stock I'm watching lately is VIX. Clearly riskier than CRMs, the moat is weaker, the management is weaker, it's probably too risky for most investors, including myself, but the share price is getting ridiculous at this point, also a possible double bottom. They acquired Base44, which is the exact AI company that was disrupting them, deeply undervalued on Forecaster, 95% below the fair value. By the way, if you want to try Forecaster, click the link below and use the discount coupon code ADRI. Instead, if you want a relatively safe investment, not financial advice of course, I have a couple more names to drop, starting with MercadoLibre. This company keeps growing like crazy year after year after year after year, going up, 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 up. Margins are under pressure because they are investing a lot in CapEx. I imagine MercadoLibre like a South American Amazon with a buy now, pay later and other financial options that I don't really fully understand, so I would have to research more. But looking at Forecaster chart, the company seems at discount, and looking at my numbers, I believe the company is cheap. Let me know if you like it. To close with the cherry on top of the cake, we have to mention SoFi. 6 months ago I made this video. SoFi was at all-time high, and I hinted that the probability for SoFi to go down at $15 was much higher than for it to skyrocket at $100. I was right, now it is at $15. And the situation is very, very different. The fundamentals are extremely strong, and the price is much more reasonable. Considering the YouTube hype around this business, it deserves our attention. Keep an eye open for an entry point if you like SoFi. This concludes my 7 company list, but I feel like I could go on. For example, if you are interested in a way safer investment, I would suggest you to look into the mega caps. And if you want to know which is my favorite Magnificent 7 right now, watch this video. Thank you. Thank you very much for watching until the end. Please comment, like, subscribe. Peace out.